Hello Deep Value community, thank you for watching. In today's video I'm going to talk about how to get started in investing. This video is for absolute beginners. So if you're new to the channel, please subscribe now so you can get my next video installment. So the most important aspect of investing is to have realistic expectations. Do not expect to double your money every year or any kind of nonsense like that. In fact, don't even expect to do anything even remotely similar to that. The most important part of investing is to have a long-term horizon. And by that I mean, it's not something heroic like 30 years, but you should at least be thinking out, I don't need to touch this capital for at least 3-4 years. Okay? If you're thinking anything less than a year, everything's going to go haywire. So I've designed this video for myself when I started out, so I hope that you find this useful, and if you could let me know if this is something that you wanted to know more about or something that could be helpful. So when it comes to investing, don't speculate, don't have a punt, don't have a guess. Try to understand fundamentally what the business does. So don't go for some kind of cool sounding small cap company. Don't go for a distressed like nano company, let's say market cap of less than 50 million. Go for something that is an established business. Go for a boring business. Now, the most important thing is that you're able to say what the business does in about 10 seconds. So for example, Apple sells iPhones. It also tries to sell services related to its ecosystem. That's it. So that's the kind of analysis that you need to do. You can go absolutely crazy in terms of trying to understand every single nuance about the company, the CEO, all that kind of stuff. It's pointless. You need to understand the business model because that's where everything gets started from. Okay? So don't speculate. Invest alongside the earning power of the company. So in your mind, you should be thinking, okay, I am buying this company, and over the next 2-3 years, the business may grow its earning power over time. By that, it increases in intrinsic value. So the market cap should approximate the intrinsic value of the company growing over time. Okay? Next, there are 3 very important financial statements. You need to start to become familiar with those. So, in my favorite statement, the balance sheet. If you do not understand the balance sheet, that's the starting point. You need to look at the balance sheet and you need to figure out how much cash does that balance sheet have, how much current liabilities it has. The current liabilities are simply liabilities that need to be taken care of in the next 12 months. So again, look at the cash on the balance sheet. That's your starting point. Then you look at the current liabilities. I've got a video that hopefully you'll be able to check out that talks about current assets and current liabilities. So understand the balance sheet. The next one is my favorite, is the cash flow statement. The cash flow statement is what I call reality. The income statement is what I would look at last. The income statement is what management want you to believe the company is able to do. Now, most analysts talk about revenue growth and EPS. Now, the EPS number is the last number you need to figure out. You don't need to know the EPS number. The EPS number is the worst number you can possibly consider. EPS is just an estimate of earning power of the company. Now, that's kind of getting a little bit advanced, but just look at the income statement last. So, start at the balance sheet. Within the balance sheet, just look at how much cash, how much debt it has. Try to understand if the current liabilities are significantly larger than the current assets. That's not a great investment. So just try to see the balance sheet, then move over to the cash flow statement. If the business is cash flow from operations, that's the first section. So cash flow statement has 3 sections. It has cash flow from operations, then it has cash flow from investments, and then has cash flow from financing activities. So the first one, cash flow from operations, is that cash coming in from the business bringing in cash. The cash flow from investing is typically money exiting for the investment, for the business to reinvest its profits. The financing activities is the business raising debt, or is it diluting the shareholders? Now, sadly, you kind of do need to understand those three. It is important, but it's simple. So if you look at the cash flow from operations and you see that the biggest number is stock-based compensation, that means the management is essentially has a large portion of the cash flows is coming from them, not at this moment diluting their options. They will at some point. So you want to see that stock-based compensation is small as a percentage of cash flow from operations. So that's really where you want to get started at. I'm possibly afraid that I may have alienated some beginners because I've maybe gone a little bit too far, too fast. But what is very important is to understand that in finance, there are ratios and terms for everything. But you can make this really, really simple. The best advice that I can give you is don't get stuck in too quickly. Try to learn about the business. So don't get all your money, lump summing in, and then just really take about 3-6 months to try and understand a little bit. You'll be surprised how much you're going to learn about investing over the next 6 months. It's a magnificent journey. It's a very humbling journey, but it's a magnificent journey nevertheless. So you're going to learn so much in the next 6 months. So here's the takeaway advice. Practice makes profits. You got to be able to put in consistent hard work, but it really does pay, and it pays huge. So before we wrap up, I hope you found that video useful. So please subscribe and see you soon.